Ever wondered why your employer takes money out of your pay before it even lands in your bank account? Or why some people get a nice tax refund while others end up getting a bill from the ATO at the end of the financial year? It all seems pretty confusing because, let's be honest, nobody really sits you down and explains how the whole thing works. But once you see how it all fits together, it's actually pretty straightforward. So by the end of this video, you'll know exactly what happens from the moment you earn a dollar to the moment you lodge your tax return. Alright mate, let's start with the basics. Income tax is simply a portion of the money you earn that goes to the government. Australia collects money from a few different places, but income tax is one of the biggest sources. That money helps pay for things we all use every day, like roads, public hospitals, public schools, Medicare, emergency services, and the Defense Force. Think of it like everyone chucking a bit of money into one big shared pot so the country can keep running. People who are working contribute, and that money also helps support things like schools, healthcare, retirees, and people who are between jobs. So while it can feel like someone's taking money out of your pay, it's really everyone pitching in to keep things running. Now, who actually pays income tax? Pretty much anyone earning money in Australia, but it depends on how you earn it. If you're working as an employee, whether full-time, part-time, or casual, your employer automatically takes tax out before paying you. If you're self-employed or running your own business, there's no employer doing that, so it's your job to put money aside and pay the tax yourself. If you invest, you can also pay tax on things like rental income, dividends, or capital gains when you sell an investment for a profit. Even some retirees pay income tax depending on where their income comes from. One thing that's also worth knowing is that Australian tax residents are generally taxed on their worldwide income, while non-residents are usually only taxed on income they earn in Australia. We won't dive too deep into that today, but it's good to know the difference exists. Now here's the part that confuses almost everyone: tax brackets. You've probably heard someone say, "Don't take the pay rise because you'll end up paying more tax and actually lose money." Sounds believable, but it's completely wrong. Australia uses what's called a progressive tax system. That simply means the more you earn, the higher tax rates only apply to the extra income that falls into the higher bracket. Your whole salary doesn't suddenly get taxed at that higher rate. A really easy way to picture it is to imagine your income filling up a stack of buckets. The first bucket is the tax-free threshold for most Australian residents, so nothing in that bucket gets taxed. Once it's full, the next dollars flow into the next bucket, which has a low tax rate. Fill that one, and only the dollars spilling into the next bucket get taxed at the higher rate. Every dollar in the earlier buckets keeps its lower tax rate. Let's put some numbers behind it because this is where it usually clicks. Imagine you're sitting right on the edge of a tax bracket and then you get a pay rise. Only the extra dollars above that threshold move into the higher bracket. Everything you earn before that still gets taxed exactly the same way as it always did. So when it comes to income tax, earning more money will always leave you with more money in your pocket. Now sure, a higher income can sometimes affect government benefits or concessions because they have their own rules, but that's completely separate from tax brackets. So if someone ever tells you to turn down a pay rise because of tax, you can confidently tell them that's not how Australia's tax system works. Now you might be wondering, if your actual tax isn't worked out until the end of the financial year, why is money disappearing from every payslip? That's because of something called PAYG, or pay-as-you-go withholding. Basically, your employer looks at the ATO's withholding tables and the information you gave them on your tax file number declaration, then estimates roughly how much tax you'll owe for the year. They take a little bit out of each pay and send it straight to the ATO on your behalf. The whole idea is to spread your tax across the year instead of hitting you with one massive bill at tax time. But because it's only an estimate, it usually won't be exactly right, and that's where tax returns come in. Before we get to that, one quick thing to remember. Australia's financial year runs from the 1st of July to the 30th of June, not January to December. At the end of each financial year, you lodge a tax return with the ATO. A lot of people mix these terms up, but a tax return is the paperwork you submit, while a tax refund is the money you might receive afterwards. The ATO adds up everything you earn from all your jobs and other income sources, subtracts any deductions and offsets you're entitled to, and works out exactly how much tax you should have paid. Then it compares that with how much tax was actually withheld during the year. If too much was taken out, you get the extra money back as a refund. If not enough was taken out, maybe because you had multiple jobs, freelance income, or your situation changed, you'll have to pay the difference. Neither one means anyone made a mistake. It just means the estimate didn't perfectly match what actually happened over the year. And the good news is by the time you lodge, the ATO already has a lot of your information from employers, banks, and other institutions, which is why so much of your return is already pre-filled. Now let's clear up another big misconception: tax deductions. A deduction reduces your taxable income. It doesn't mean the government gives you back every dollar you spent. For example, if you buy something for work that costs $200 and it's genuinely deductible, you don't automatically get $200 back. Instead, you save the tax you would have paid on that $200, and exactly how much that is depends on your tax bracket. Common deductions include things like work-related tools and equipment, required uniforms, some home office expenses if you work from home, and self-education costs that directly relate to your current job. They're definitely worth claiming if you're entitled to them, but you still paid for the item in the first place, so they reduce your tax bill rather than making the purchase free. And remember, you'll generally need receipts or other records to back up your claims. Before we wrap up, here are a few mistakes that catch people out all the time. Believing a pay rise leaves you worse off because of tax brackets, which we now know isn't true. Thinking the tax taken out of every payslip is your final tax bill when it's really just an estimate. Assuming everything you buy is tax deductible, even when it has nothing to do with earning your income. And finally, forgetting to lodge your tax return on time, which can lead to penalties that are completely avoidable. So to bring it all together, income tax helps fund the services Australia relies on every day. The country uses a progressive tax system where only the income inside each tax bracket gets taxed at that bracket's rate. PAYG withholding is simply an estimate collected throughout the year while your tax return works out the actual amount you owed. And tax deductions reduce your taxable income, they don't hand you back every dollar you spend. Hopefully that makes the whole system feel a lot less confusing. And if it did, make sure you stick around because in the next video we're breaking down the Medicare levy, HECS debt and tax refunds in the same simple, no jargon way.